The U.S. economy added 139,000 jobs last month, higher than the expectation from economists of 125. However, the BLS also reported a pair of downward revisions, saying the U.S. added just 120,000 in March instead of 185 that was originally reported, and added only 147,000 in April instead of the 177 previously released. So two previous downward revisions worth noting. Meanwhile, unemployment rate holding steady at 4.2%. Joining me now to break it all down is Satyam Panday, chief U.S. and Canada economist for S&P Global Ratings. My man, thank you for being here. Okay, so we're seeing futures off and running. The S&P expected to open 0.8, the Dow 0.7. Small caps leading the way here, up 1.3%. Take me through it. What did you learn this morning?
Well, thanks for having me. Basically, the report comes in with as expected numbers, both in terms of payroll jobs gain and unemployment rate, and hourly wage earnings as well. One thing of note, though, that it is a softening trend overall, which makes sense because of the population growth also weakening in the US. But at the same time, the overall breadth of job gains across the industry has becoming narrower. It's a lot of it has to do with healthcare sector, leisure and hospitality. The private sector itself did add jobs, but that breadth has been narrowing over the last 12 months or so. One thing that was as expected as well is the federal workforce cut, those jobs cut. They were showing up the last 3 months, and this month as well, it has showed up. That should continue to happen over the next couple of months as well.
What are you to make of the difference between the ADP print and the Bureau of Labor Statistics print, Satyam? I know they don't always line up, but man, when they miss, they really miss. What happened this week?
You know, they've in the last 2-3 years, they haven't really been. They have been going in the same direction somewhat, but the magnitude has been quite off. It does get revised. These numbers are not perfect in their advanced estimates. Generally, they do tend to get revised, and then after several revisions, it does start to line up more. But for now, we would definitely not take the ADP numbers as something of a leading indicator for the government's number coming in.
No, I do think for a lot of people, they kind of set expectations, at least maybe set the stage of a narrative into Friday morning, but clearly not exactly the numbers that we saw across the print. We are seeing yields move up a little bit. Can I get your perspective on what your expectation is for the day? I mean, listen, we're seeing equities price positively for an implied open 25 minutes out, but I couldn't help but notice before we came up here, the 10-year starting to creep back up a little bit.
Yeah, if you think about it in terms of some of the uncertainty on the downside, it sort of takes that away, because May, after all, was the month when uncertainty was quite high in the beginning. We had the trade and tariff related issues sort of back and forth. But overall, the economy still did just fine. Yes, it is softening in a cyclical manner, but not really falling off the cliff. So what will the Fed do is the question when it comes to these bond yields. It did go up after this announcement. The Fed is likely going to just stay tight. They're going to stay back, wait and see till more clarity emerges on the policy front. Right now, the labor market hasn't really weakened enough for them to be certain about going out and easing again. So that's what the investors are also seeing, and they are repricing some of these things.
I just pulled up the CME Group's FedWatch tool, 99.9% likelihood of holding rates steady for the June 18th meeting. July, it looks like mostly a comparable story. It's not really until you push until the September 17th meeting, you start to see an effort that maybe we get a cut of 25 basis points. What would be your expectation, Satyam, if any, for an interest rate cut? I feel like we have this conversation a lot, and we look at the data and we say, is it really there for the Fed to cut? What's your take on it?
So my take is right now they are at a place where the upside risk to inflation, right, that is kind of building given the tariff related issues. But at the same time, we're not really quite seeing the same kind of weakening of the labor market that many had thought would happen by now. We think that the labor market is going to continue to soften, but that's going to be in the fourth quarter of the year. Once it gets under 100,000 jobs gained per month, they'll have more confidence that they probably want to start to ease. So that brings us maybe 50 basis point rate cut in the fourth quarter of this year, and not before that. That's our expectation.
Satyam, before I let you go, I know you cover Canada as well. We did see action, not just from the ECB, but Bank of Canada as well, holding their key interest rate at 2.75%, but they did identify tariff negotiations as, quote, highly uncertain. What drove that decision, and what do you track out of Canada that we here in the States should follow a bit more closely?
Well, in Canada, growth rates have held up rather surprisingly well. And at the same time, some of the key metrics, the inflation metrics that the Bank of Canada likes to look at, the CPI trim and the CPI median, they've been actually showing a little bit of a higher inflationary impulse in the last 3 months. So those taken together, it was sort of a no-brainer that they would pause, at least for the time being. But it seems still to me that the communication bias is towards easing in the upcoming months for Bank of Canada as well.
An implied opening for the S&P 500 of 0.8% today. We're going to be off and cooking on this Friday. No better way to kick things off than chatting with you, my man. Thanks for being here, Satyam Panday, Chief U.S. and Canada Economist for S&P Global Ratings.